a company created the most addictive toy on the planet, leading millions of people to fight over a plush monster and pay 10 times the retail price just to own one. Then, in a boardroom meeting, they made a deliberate decision to destroy the very element that made the toy addictive in the first place. No competitor did this to them. There were no scandals or lawsuits. They did it to themselves, and this decision made total sense on paper. Today, let's discuss how LABUBU went from being the hottest item on Earth to serving as a cautionary tale for every company pursuing viral growth. By the end of this video, you'll understand exactly what made this toy so addictive and the one decision that silently led to its downfall months before most people noticed anything was amiss. Let's dive in. Before we discuss the collapse, it's essential to understand what LABUBU really was beneath its fluffy fur and sharp teeth. It wasn't just a toy company, it was more like a casino disguised as a gift shop. Here's how it worked. You would walk into a store and pick up a sealed box for around $20 without any idea of what was inside. You could receive a common figure, or if you were among the lucky few, only about 72 people, you might land the rare secret edition. This uncertainty was not just a minor detail, it was the entire concept behind the product. Psychologists refer to this as a variable reward. It's the same mechanism that makes slot machines so hard to resist. Your brain releases more excitement when pursuing an uncertain reward than when receiving a guaranteed one. Casinos have known this for a century, and this company simply wrapped the same concept in soft, plush fabric and marketed it to young adults on social media instead of seasoned gamblers in Las Vegas. To enhance the addictive element, the company deliberately kept stock lower than demand, causing stores to sell out quickly and turning buyers into hunters. This artificial scarcity created a resale market where a $20 toy could be sold for hundreds. When your friend tells you that the toy she bought for $20 is now worth $300, you're no longer just buying a toy. You're investing in what feels like a guaranteed opportunity. That's the real mechanism at play, not just a cute monster, but a perfectly engineered cycle of uncertainty, scarcity, and social proof. It was so effective that over half of all customers who bought one toy returned for more. Interestingly, this character wasn't created by a marketing team. It originated from a children's picture book, illustrated years before the company even licensed it. For years, it sat quietly in the catalog, just one character among dozens, doing fine but nothing remarkable. Then it was turned into a small plush keychain, and a single celebrity photo ignited a trend. Sales in parts of Asia jumped nearly a third within a week of that post. More celebrities joined in, and the West took notice late, as it typically does. By the time it did, the popularity had already surged. Within about a year, that one character alone was generating hundreds of millions of dollars. The following year, sales approached $2 billion. At its peak, the company behind it was valued on the stock market at more than 3 of the biggest legacy toy companies combined, companies that most people had grown up with, now outdone by a plush monster from a company whose name many Westerners still didn't recognize. Let's pause for a moment because this is a key point. While a celebrity photo can spark a trend for a few weeks, it cannot sustain 2 straight years of explosive global growth on its own. Something more fundamental was driving this success, and understanding that underlying structure makes the eventual collapse clear. If you're interested in how companies engineer this kind of demand, this channel explores it every week. Make sure to subscribe so you don't miss the next episode. Now, back to the story. Here's where things start to get painful to watch as the mistake is apparent from a distance, yet the company walked right into it. By 2025, demand had spiraled completely out of control. Fights broke out in stores, and a warehouse was robbed. Scalpers armed with bots bought up entire drops before regular customers could even access the checkout page. From within the company, this clearly appeared to be a problem to solve. Millions of people wanted the product but couldn't get it. There's a rule that almost every business school teaches. When demand outpaces supply, you should increase production. The company's leadership even compared the situation to concert tickets. While a stadium can't add extra seats, a factory can certainly scale up production. They questioned why some scalpers were profiting instead of the fans who deserved it. This is a reasonable argument. For almost any other product, it would have been the right decision. The issue, however, was that nobody was paying $300 for a plush toy simply because it was worth that amount. They were paying $300 because it was scarce. The scarcity wasn't a flaw in the system. It was, in fact, the product itself. When the company scaled its production from around 300,000 units a month to roughly 30 million units a month in under 2 years, multiplying output by 100, they weren't addressing a supply issue. Instead, they were quietly destroying the very appeal that had originally drawn customers in. Imagine a nightclub that is renowned for its long, exclusive line around the block deciding that the solution to its popularity is to let everyone inside at once. Sure, more people gain entry, but soon nobody is posting about how exclusive the experience felt, and before long, the line disappears entirely. As supply eventually caught up with demand, the resale market reacted predictably. Prices on the secondary market began to drop, and when buyers saw that some editions were being sold for less use than their new price in stores, the entire perception of the product as a smart investment vanished overnight. Scalpers holding onto inventory quickly started selling it off to minimize their losses, pushing prices down further and triggering even more sales. From a business perspective, what makes this situation genuinely intriguing is that, for a while, the negative effects weren't visible in the headline numbers. Revenue continued to grow throughout most of 2025 because the company was still shipping vast amounts of product to stores, even as actual consumer interest was quietly diminishing. The sales figures reflected past performance, while resale prices hinted at the impending reality. By the time the full-year results were released in early 2026, it was impossible to overlook the cracks in the situation. Despite annual revenue having increased significantly and profits multiplying several times over, the company's stock dropped sharply on the same day the results were announced. Investors could see what the headline numbers were masking. One single character now accounted for nearly 40% of the entire company's revenue, a dramatic increase from the previous year, while other characters were severely underperforming expectations. The decline didn't stop there. In the months that followed, the stock continued to plummet, ultimately losing more than half of its value from its peak the previous summer, wiping out tens of billions of dollars in market value. By spring, sales in the United States, one of the company's biggest growth markets, had started to decline year over year, a stunning reversal after months of triple-digit growth. Inventory was piling up in warehouses, lingering longer than before, finally being sold. Counterfeit products worsened the situation. Fakes flooded online marketplaces so aggressively that, in some areas, they accounted for a significant share of total listings. When your entire product relies on feelings of authenticity and status, an overwhelming presence of knockoffs is detrimental. This pattern is worth noting because it reflects a larger issue beyond just one toy company. This company achieved something genuinely rare. It built real, global, organic demand for a product originating in Beijing, appealing to Western cities that typically favor Western brands. That aspect of the story represents a legitimate business accomplishment, not mere hype. However, once they had this demand, they approached it like an ordinary supply chain issue to optimize, instead of recognizing the delicate, curated feeling it truly represented. You cannot mass-produce exclusivity. The moment you attempt to do so, you're no longer selling a product. You're merely selling plastic and plush fabric at a markup, and eventually, customers will notice the difference. So, is this company finished? Not at all. It still has billions in profit and a substantial global presence. However, the version of this brand that had people lining up at dawn and fighting over a keychain? That version may be gone for good, and no movie deal or theme park is guaranteed to restore that particular feeling. If you or someone you know got caught up in this craze, whether buying in or cashing out at the peak, I'd love to hear about it in the comments. Share your experiences. If you enjoyed seeing how a company can create $1 billion craze and then dismantle it with a single strategic decision, that's exactly the type of story this channel explores every week. Subscribe, turn on notifications, and I'll see you in the next one.